This is session number 3 of the WCI Real Estate Masterclass. Today we're going to talk about using real estate to reduce your taxes, and really all about how to invest in real estate in as tax efficient a manner as possible. This is what we'll be talking about today. We're going to be talking about the philosophy of tax reduction, really my philosophy of tax reduction. We're going to be talking about the basics of the tax code. We're going to talk about retirement accounts and how they can be related to real estate investing. We're going to talk about deducting expenses. We're going to talk about winning the tax game long term. We'll also talk specifically about how to determine your improvement ratio. And then there'll be some interesting techniques and strategies I'll talk about briefly, such as renting your house to your business, taking advantage of the home equity exclusion, achieving rep status, the short-term rental loophole, opportunity zone funds, and tax breaks for real estate investment trusts. First, let's talk about the philosophy of tax reduction. And here it is in a nutshell. Be honest, but aggressive. Keep good records, and don't fear the IRS. When we're talking about tax reduction, a lot of people don't understand the terms, okay? In this talk, I am talking about tax avoidance. That is legal methods of reducing your tax bill. I am not talking about tax evasion. Tax evasion is illegal. It's not paying taxes that you owe. But there is no requirement for you to pay more taxes than you owe. There is nothing wrong with arranging your financial life in such a way that you pay less taxes. So there are a lot of things in the tax code that are very black and white, right? For example, if you do a 1031 exchange, and if you do not identify the property by a certain date and you don't make the exchange within 180 days, then you have failed to do a tax-free exchange. You will pay capital gains on that transaction. If you do make the timeline, you don't pay. It's very black and white. However, there are lots of other things in real estate investing in the tax code that are much more gray. For example, your improvement ratio. We'll be talking about that a little bit later. What I'm saying is when it's gray, call it in your favor. I also think you should keep very good records. What records do is it shows the IRS that you are not being careless with your taxes. Plus, a lot of these tax deductions, if you get audited and you don't have the proper records, you simply lose it. You also need to have clear arguments for any positions you take, right? It shouldn't just be a claim of ignorance. You need to be able to argue why you chose to call the gray in your favor, for instance. But in general, people leave money on the table because they're afraid they'll get audited. If you deserve a deduction, take the deduction. If you deserve a credit, take the credit. Chances are you won't be audited. And if you do, you're going to pass it because you deserve it. Okay, so let's talk about the 3 things you can be nailed with in the event that the IRS comes after you. Okay, the first one is a deficiency. A deficiency is an honest mistake or a difference of opinion. If you get a deficiency, and it might just come as a letter saying you have a deficiency, or it might be the result of an audit, what you have to do is you have to pay the tax you owe and any interest on that tax due. That's it. It's just an honest mistake. These happen all the time. The next step up, however, is negligence. And with negligence, you broke the law. This is when you have no excuse for the mistakes you made. You're not making any sort of a reasonable argument. You made no effort whatsoever to approximate your taxes. You didn't keep any records. You didn't pay on time. And you intentionally disregarded valid rules. That's negligence. And when you have been negligent, you not only have to pay the tax and the interest, but you have to pay a penalty. The next step beyond negligence is fraud. And fraud is a crime. Now, under our criminal system, you are innocent until proven guilty. And that's significantly different from how deficiencies and negligence work. In those cases, you have to prove that you deserve the deduction. So, in essence, you're guilty until you're proven innocent. But with fraud, it's just the opposite, because this is a crime, right? You're innocent until proven guilty, and the government must prove that you intentionally broke the law. So, if they're able to do that, you may have to pay the tax, the interest, some penalties, and even go to jail. All right. So around 1% of returns are audited overall. Now, those numbers change. If you pay nothing in tax, you actually have about a 9% rate of being audited. If you are making more than $1 million a year, you have about a 2.5% chance of being audited. If you're making more than $5 million a year, it's about a 5% chance of being audited. And if you're making more than $10 million a year, it's about an 8.6% chance of being audited. But on average, about 1% of returns are audited. And when an audit happens, one of three things can happen. The first is that the IRS owes you. And this does happen from time to time. I have had the IRS send me checks I was not expecting with a letter saying, hey, you overpaid your taxes. And that does happen. It can also, the result of an audit can be that there's no change in your tax bill. That does happen. But most of the time, about 75% of the time, the result of an audit is a deficiency. And you have two choices of what to do with a deficiency. The first is you can just pay it. You can write a check and be done. Essentially, your tax return is step one in a negotiation over your tax bill. And you said, here's my offer, and sent in your tax return. When they do an audit, that is basically their counteroffer. And you can just take it and pay it. Or you can counteroffer again. And what that means is that you're fighting it. You're going to go to tax court. And what happens if you go to tax court? Well, about 4% of the time you win. That's not very often, but 4% of the time you win. You lose about 36% of the time. So a little more than a third of the time you lose in tax court. The rest of the time is something in between. Let's call that a draw. So about 60% of the time you do better than you would have done had you just paid what the auditor says you should pay. So there is, the odds are with you if you go to tax court that you will reduce your tax bill. One thing you do need to be aware of, though, if you go to tax court, is that the entire return will be looked at. A lot of times an audit is just looking at one part of the return, but they're going to look at your entire return if you go to tax court. So if you are cheating somewhere else on your return, that could be caught as well. But if you've been honest with your return, you're filing your taxes as you should, you really shouldn't be afraid of that. All right, let's talk about the basics of the tax code. If you look at the top of your tax return, you start with, this isn't even on your tax return, it's your gross business revenue. And if you subtract your business expenses from that, that might be, if you're in real estate business, it might be mortgage costs, it might be property management fees. You don't pay payroll tax on any of the expenses you have in a business. But once you subtract out your business expenses, that leaves you with your total income. And you subtract from that your above the line deductions. These include things like self-employed health insurance, self-employed taxes, self-employed retirement accounts, HSA contributions, those sorts of things. And once you've subtracted out your above the line deductions, you get to the line. And the line is your adjusted gross income. And the number of that line varies by the year. On your 1040, the number is different every year or two. But it's always the adjusted gross income. And once you get to that adjusted gross income, then you can subtract out your below the line deductions. And these are one of two things. The first is either itemized deductions, and these are primarily your personal mortgage interest, charitable contributions, and up to $10,000 in state or local taxes. If you do not have that many itemized deductions, you simply just take the standard deduction and subtract that from your adjusted gross income. And that leaves you with your taxable income. Your tax is calculated based on your taxable income. And then you apply any credits, anything you've already had withheld or that you paid as quarterly estimated taxes or that you had them hold on to from last year's, tax refund, that sort of a thing, as well as any payments you've made toward your taxes. And then whatever you haven't paid is your tax due. If you've overpaid, you get a tax refund. That's the way the tax code works. Every single deduction fits in there somewhere as a business deduction, as an above the line deduction, as a below the line deduction, or as a credit. So it's important that you understand the difference between marginal and effective tax rates. Your marginal tax rate, also known as your tax bracket, is the tax rate at which the next dollar you earn will be taxed, or at which the last dollar you earned was taxed. So a lot of times that might be quite high. The highest tax bracket is 37%. In my state, the highest tax bracket is just shy of 5%. So my marginal tax rate is 42%. If I earn another dollar, 42% of it is going to the tax man. It's actually a little higher than that if it's earned income because you got to add in some Medicare tax. But what an effective tax rate is that you take all the tax you pay and you divide it by all the income you made. And your effective tax rate is always going to be less than your marginal tax rate. My marginal tax rate is like 42%. My effective tax rate is much more like 31, 32, 33%. And the reason why is that some of my income is taxed in the lower tax brackets. And so that has the effect of lowering the overall tax rate that I pay, because not all the money is taxed in the highest tax bracket. Another thing to understand about the tax code is that lots of tax credits, lots of deductions have phase outs. As you earn more, you lose that particular deduction. And while for the most part, those are relatively smooth, the more you earn, you lose little by little. Occasionally in the tax code, there's a place where there's kind of a cliff, and you can earn a few dollars more and actually end up paying significantly more in taxes. But for the most part, those are pretty rare in the tax code. And most of the time, it's a pretty gradual process. It's also important that you understand the difference between earned and unearned income. With earned income, you're generally paying payroll taxes. With unearned income, you generally are not. What are payroll taxes? Well, they're Social Security taxes and Medicare taxes. K-1 income, partnership income, can be either earned or unearned income. It just depends on the partnership. In fact, this year, as I went over my taxes with my accountant just before I filed, we were able to look at all the different sources of income, all the different K-1s I get, and it was, a bit of an exercise deciding what was earned, what was unearned income. And it can really be a little bit confusing sometimes if you have a lot of partnerships. But only earned income can be used for retirement account contributions. So the downside of earned income is that you have to pay payroll taxes on it most of the time. The upside of earned income is that it counts toward the amount of money you can use to calculate your retirement account contributions. Different types of income are taxed at different rates. Ordinary income tax rates vary from 10% to 37%, and these are applied to rents, to interest, to S-corp distributions, to short-term capital gains, and to unqualified dividends. However, you can get a tax rate of between 0 and 20% on long-term capital gains and unqualified dividends. Depreciation recapture is recaptured up to 25%. So that never goes above a tax rate of 25%. Now, the Obamacare taxes or the Affordable Care Act taxes are about 3.8%. And you either pay that as Medicare tax plus this 0.9% tax, or you pay it as your net investment tax, which is the total 3.8%. So when people talk about paying 23.8% on their qualified dividends and their long-term capital gains, they're adding those Obamacare taxes onto their long-term capital gains rate or onto their qualified dividends rate. All right, let's talk about retirement accounts and how they can be used to invest in real estate. Retirement accounts are fantastic, wonderful things. They are a gift from the IRS. They are a gift from Congress. They lower your taxes and thus increase your investment return. They make your estate planning far easier. They also provide significant asset protection in every state. So they're good things to use. But a lot of people wonder, man, it's hard for me to invest in real estate when I have this money in retirement accounts. Well, the simplest solution, the thing a lot of docs do, is you use your retirement accounts to invest in stock and bond index funds, and you use non-qualified money for real estate. Because equity real estate can be very tax efficient. The income is often covered by depreciation. You can exchange it from one property to another tax-free using a 1031 exchange. And then when you die, your heirs get a step up in basis at death. Even if you sell the property, you pay the lower depreciation recapture rates and the long-term capital gains rates. Now, debt real estate, on the other hand, is probably my least tax-efficient asset class. It's a great thing to put in a self-directed IRA or 401k. Keep in mind that if you put leveraged equity real estate in retirement accounts, UBIT, unrelated business income tax, is owed in IRAs, but not in 401ks. So if you ever have the choice and it's a leveraged equity real estate investment, you want to put it into a self-directed 401k, not an IRA. But what most people do, They use their retirement accounts for their stocks and bonds via mutual funds, index funds usually, and then they invest in real estate with other money. However, if all you have is 401k money and IRA money, you can look at a few other options. One is you can borrow against each 401k you have. You can borrow out 50% of what's in the 401k up to $50,000 a year, or up to $50,000 total, whichever one basically is the lowest amount. So if you have $50,000 in there, you can borrow 25. If you have 100 in there, you can borrow 50. But you can do that from your account, from your spouse's account. If you have a second 401k, you can take another 50 out of that account. And so that is an option to borrow money out and buy real estate using that borrowed money. It is a 5-year loan. However, if you separate from the employer, you have to have the loan paid back by tax day for that year. So if you borrow the money out in February, it's due back if you leave that employer by April of the next year. You can also invest really easily in publicly traded real estate inside retirement accounts. Almost every 401k and IRA has an option to invest in some sort of a REIT or other publicly traded real estate. You can roll that money over to a self-directed IRA or 401k. It's relatively easy to invest in real estate using self-directed retirement accounts. What I would be very cautious about, however, is withdrawing retirement account money in order to invest in real estate. Because when you take that money out, it gets taxed at your marginal tax rate plus a 10% penalty. Then you lose the asset protection you had inside that 401k. So your investment has to do one of two things. One, it's got to provide a very high return to be worth paying all those taxes now in a high tax bracket with a penalty. Or two, you need a whole bunch of depreciation, like the bonus depreciation you've been able to get the last few years in order to offset the tax costs of pulling money out of your 401k. All right, let's talk about deducting expenses. A lot of people love this aspect of real estate investing, but this is the same with any business. You can deduct ordinary and necessary expenses for managing, conserving, and maintaining your rental property. Okay, that includes mortgage interest, not the principal, but the interest, property taxes, repairs and maintenance, operating expenses, management fees, employee costs, utilities, electric, gas, water, sewer, garbage, etc. Travel expenses to find a property, collect rent, or maintain a property. You know why everybody's got their properties in Hawaii, right? So they can write off some of those expenses when they go to visit it. Advertising expenses, home office expenses, lawn care, landscaping, snow removal. Any losses from theft, environmental damage, a tree falling on the house, vandalism, those are all deductible. Personal property as well, such as appliances or furniture. HOA dues, legal services, accounting services, software, the cost of looking for a new property, including mileage, parking, and tolls. Your internet and cell phone, you can deduct the percentage used for business, pest control, HVAC servicing, and one of my favorite deductions, and I really like this one, is hiring your kids to work at the property. If the kids are working for a business that is entirely owned by their parents and is not a corporation, and they're under 18, they don't have to pay any payroll taxes on the money they earn. They probably won't earn enough to owe any income taxes, but it is earned income. So they can then take it, put it into a Roth IRA, and that money will never be taxed. So it's a deduction to you, and it'll never be taxed again. Remember, though, that not everything you spend money on is deductible. Some spending has to be depreciated over time, or worse, added to basis. Now, a deduction is better than a depreciation, is better than addition to basis. Because the deduction, you get to take the whole expense this year off your income before calculating your taxes. With depreciation, you can only take part of that expense this year before calculating your taxes. With an addition to basis, you don't get the benefit of that until you actually sell the property. But remember when deducting expenses that you're not coming out ahead by spending money. You're always coming out behind, but it does allow you to spend with pre-tax dollars. As a general rule, repairs are deductible, but improvements have to be depreciated. So if you got a hole in your roof and you just put a little repair on it, that's deductible. If you replace the roof, that's an improvement. All right, let's talk about the tax game long term. And this is where equity real estate, owning the real estate property, especially directly, can really shine as a tax-efficient technique. First, you buy the property. Then you depreciate it over a number of years. Then you exchange that property, usually to a more expensive property. You preserve your basis, but don't pay any capital gains or depreciation recapture via a tax-free 1031 exchange. Then you depreciate that new property. You exchange it again. You depreciate the new property. Eventually, you die, and your heirs benefit from a step up in basis. That means it's as though they inherited the property with the property worth what it's worth today. It's as though they bought it at today's price, the day you die. And so there are no capital gains if they sell it right away. There is no depreciation recapture from all that depreciation you had over your entire lifetime. So it's a very, very tax efficient way to invest in real estate long term. All right, let's talk about your improvement ratio. And what is an improvement ratio? Well, we're talking about the improvements on a property, and the improvements are the building. And when you go to depreciate a property, you can only depreciate the building. You can't depreciate the land. So when we're talking about an improvement ratio, we're asking what percentage of the property value is in the building. And what you want is this number to be high. You want the high improvement ratio. The higher the better, because you can get more depreciation from it. So there's basically 4 ways to calculate your improvement ratio. The first one is to look at your tax assessment. They will come up with a ratio for you, and that's one option. That's a very reasonable option to just use what the tax assessment used. The second option is to get a formal appraisal. You may have gotten an appraisal when you bought the property. You can get one after you own it, and that will give you an improvement ratio. The next method is to consider the replacement cost for that building by talking to a contractor or insurance company and documenting that conversation. And the last way is to look at comparables in the area and see what improvement ratio they use. And if you really want to do this the right way, you'll do all 4 methods and take the highest ratio. Make sure that you document your reasoning, because this is one of those gray areas. And as long as you have a really reasonable basis for your opinion, that's okay. But you need to have a reasonable basis for it. All right, here's another cool trick you can do with the tax code and real estate investing. You can rent your house to your business. Okay, you've heard of the home office deduction, right? This has some requirements. You have to use that space, that home office, both exclusively and regularly for your business. If you're using it for something else, you can't take the home office deduction. If you're not using it regularly, you can't take the home office deduction. Now, the easy way to take this is what's called the simplified method. And that allows you to take a deduction of $5 per square foot for up to 300 square feet in your home. That's an area of 30 by 10. It's a pretty good size home office. And that's really easy. It doesn't have to be recaptured. It's very easy to calculate. The second way is to use the actual costs, including depreciation of the property. But then you divide them, or you multiply them by the ratio of your home office to the entire square footage of the house. So it's the square footage of your home office divided by the square footage of the entire house. You multiply that by all the expenses of the house, including depreciation. And that can often be a larger amount, particularly for a really big home office. Or a really, well-furnished home. But the one downside here, aside from the fact that it's far more complex to calculate, is that the depreciation gets recaptured when you sell it. A much better option, or something you can use in addition to the home office deduction, is a self-rental. You can rent your house to anybody you like for less than 15 days a year and not pay taxes on the rent. That includes renting your house to your business. Your business can now take that cost as a deduction. It's tax-free income to you. So up to 14 days per year. It's a great benefit. Now, how do you figure out how much to rent your house for? Well, look up similar houses on Airbnb or Vrbo in order to justify the price. Print those out. Keep documentation of them. Also document the reason you were renting it to your business. Whether it's a party for other employees, whether it's a meeting held at your house, whatever it is. It doesn't have to be a smart business decision, but you do need a business reason for the rental, and you need to keep good records of that. All right, another interesting trick is to understand how to use the home equity exclusion to your advantage. When you sell your residence, you owe capital gains taxes, either short-term or long-term. However, you can usually exclude $250,000 in gains from taxation. If you're married, you can double that, $500,000 in gains. A lot of people don't realize that you owe capital gains taxes when you sell your house and buy another one. But as long as it's less than 250,000 or 500,000, you don't. And that's why most people don't realize it. But that number hasn't been indexed to inflation. And especially in more expensive housing areas, it's pretty easy to have more appreciation than $250,000 while you live in a house, especially if you've been there for a long time. In order to exclude that $250,000 to $500,000, though, you must have lived in the residence for 2 of the previous 5 years. So that opens up 2 strategies that you can use, combining your house with a real estate investment. The first one is to live there for 2 years, then rent it out for up to 3 years, and then sell it. Then you get the home equity exclusion. Option number 2 is to take one of your rentals, turn it into your residence, live in it for 2 years, and then sell it. Again, you can take advantage of that home equity exclusion. Now, keep in mind, you can only take this home equity exclusion once every couple of years. Of course, if the property is going to be sold at a loss, which occasionally happens, it's actually better for it to be an investment property at sale than it is for it to be your residence. All right, let's talk about real estate professional status, or REPS. This is the holy grail of tax breaks for physician real estate investors. It allows you to use your real estate losses, primarily depreciation in the last few years, really big amounts of bonus depreciation, against your earned clinical income. So the best use of this has been a working physician married to a real estate professional. So the real estate professional gets all the losses, the working physician gets all the income. You combine them, and they may pay no taxes at all on their income. However, there's some fairly strict requirements to get real estate professional status. And this is an area of the tax code that does get audited. So you need to meet the requirements. You need to be able to prove you meet the requirements. The first requirements are the work requirements. That means you worked, or this real estate professional, whichever spouse it was, worked 750 hours in real estate and not more than that in anything else. So this isn't a full-time doc that also put in 750 hours in real estate. This is someone who's primarily working in real estate. And they have to be working hours, not investing hours, okay? So development counts, management of the property counts, leasing activity counts, but education, searching for properties, studying financial statements, those don't count. Okay? It's all about working in the real estate, not just investing in real estate. Okay, beyond the work requirements, there's also a material participation requirement. You must actually participate in each property to use the losses from that property. Now, you can make a grouping election to combine some of your properties. But basically, in order to prove material participation, you have to do one of the following things. You have to put in 500 plus hours on that property. You have to do substantially all of the participation in that property, meaning you did almost everything for it. Or you put in more than 100 hours on that property, and that was more than anyone else put in on it. Now, there's a few other ways you can prove material participation, but those are the main ways used by real estate investors. So those are the requirements to be able to use those depreciation losses against your earned income. It's not just, I'll buy the properties and you manage them, and then you'll be the real estate professional. Like I said, this is a heavily audited area of the tax code. You're going to have to prove your hours. You're going to have to prove your material participation. Now, you may also be able to group in some of your passive syndications if you're qualifying based on your direct investment work. So if you think about this, how many properties do you need to qualify? Well, if you're managing that property really, really efficiently, let's say only 15 hours a year you're putting in, this could require 50 plus properties or 50 plus doors of tenants. If you're putting in 2 hours a week per property, however, it could be just like 8 properties, 8 or more properties. If you're doing really heavy renovation work, if you're doing fix and flips, it could be even fewer. But the bottom line is you really do have to be a real estate professional. You probably shouldn't be trying to claim this if you only have 1 or 2 properties under management. All right, there is one loophole to it, and this is known as the short-term rental loophole. And the reason why is that the IRS looks at you, if you were in the short-term rental business, as being not in the rental business, but in the hotel business. And so the requirement that goes away if you're doing short-term rentals, and they define that as, I think, an average, tenant stay of 1 week or less. is you no longer have to meet that 750-hour requirement, and it no longer has to be more than 50% of your professional work. So that's a huge plus. You still have to meet that material participation test, though. If you buy a property and use it as a short-term rental until the bonus depreciation is used up, and then convert it to a long-term rental, you can really use this short-term rental loophole to your advantage. So consider that when you first buy a property, that would be a short-term rental for the first year or two. All right, another interesting tax break available with real estate is what's called an Opportunity Zone Fund. And these came about from the Tax Cuts and Jobs Act of 2017 that went into effect in 2018. And the idea behind it was really idealistic. It was to encourage investment in downtrodden areas. But the reality is that most opportunity zone investments are in areas that either barely qualify as an opportunity zone or are mistakenly qualified as an opportunity zone. So the investors get the usual real estate returns plus some cool tax breaks. Well, what are the tax breaks? Well, there's essentially three of them. The first one is a deferral of any capital gains taxes. So if you take any investment and within 180 days of sale, put that money into an opportunity zone fund, you don't pay gains until the fund is sold or the end of 2026, whichever comes first. The second tax break is you get a partial step up in basis. So if you stay invested in that opportunity zone for at least 5 years, your basis increases by 10%. So essentially gives you some of that increase that you don't have to pay taxes on. If you stay there at least 7 years, the basis increases by 15%. The final tax break available with an Opportunity Zone Fund is to avoid paying capital gains taxes on the increase in value in the fund. If you leave money in the fund, after you've exchanged these gains into it, if you leave money in there for at least 10 years, you will owe no capital gains on the fund's gains. So a pretty cool thing to do if for whatever reason you've sold a practice, you sold a particularly expensive building, even if you've just sold a bunch of, appreciated mutual funds, you can use an opportunity zone fund to minimize the tax effects of that. Real estate investment trusts have this reputation as being terribly tax inefficient. And they mostly are fairly tax inefficient, but there are some tax breaks available to REITs. The first is what's called a return of capital distribution. And this is actually how a REIT passes depreciation through to its investors. They do not send you a K1, right? And you don't fill us out on Schedule E like you would for a direct real estate property. Instead, you get a 1099, but it doesn't include some of the distributions you got because they were considered return of capital. So it's the method that REITs pass depreciation on to the investors. The downside of getting your depreciation that way is that it can't be used against any other investment gains you might have. The second tax break that REITs get is the 199A deduction, also known as the qualified business income deduction. Essentially 20% of dividends that it's paying out that are normally fully taxable at your ordinary income tax rates, 20% of them become tax-free. That's the 199A deduction, and that's through the year 2025. Many funds, especially debt funds, these private debt funds, have adopted a REIT structure to take advantage of that little tax break. Another great tax advantage of REITs is that you don't have to file multiple state returns. You get sent a 1099 instead of a K1 with 12 state K1s, for instance. So if you invest in a private real estate fund, if it's paying you on a K1, you may be filing in 10 or 12 states. Wouldn't be that unusual. But if you're just investing in a REIT, you're just going to get a 1099. And so not only do you get that, in February instead of in April or July, you're also not going to have to file in any states for it besides your own. All right, so to summarize this tax information we've been talking about tonight, be honest, be aggressive, keep good records, and don't fear the IRS. You need to understand how the tax code works and favor the sources of income that are less highly taxed. Use retirement accounts, but generally keep equity real estate outside of them. Be sure to deduct your legitimate expenses, but don't spend more than you need to spend. Depreciate, exchange, depreciate, exchange, depreciate, die. That's how you invest most tax efficiently. Use the highest improvement ratio that you can justify. Rent your house to your business for 14 days a year. Take advantage of the home equity exclusion whenever possible. Rep status, while powerful, is more about changing careers than an easy deduction to get. The short-term rental loophole can help you get around the REPS requirements, though. Opportunity zone funds can provide some additional tax breaks if you have gains. And REITs are more tax efficient than you might think. All right, we've been talking now for the last 3 sessions in this masterclass about real estate investing. And I want to let you know it's been a joy to be with you. But if you want to spend more time together, if you want to learn more about real estate investing, I suggest you upgrade to the full course. Now, this full course is not free, but it's well worth the investment. We call it no hype real estate investing. The reason why is because every time I'm seeing seminars and courses and books out there, a lot of them have a lot of hype. Rah, 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 you can do this, and nothing bad ever happens in real estate. They leave out the fact that they've been bankrupt once, or they leave out the fact that they've been scammed or lost money or had trouble with tenants, right? They only show you the good parts about real estate investing. We don't do that in no hype real estate investing. We're going to tell you the way it really is. But we go into far more depth on each of these subjects than we covered in the masterclass. And we cover lots of subjects that weren't even in the masterclass. Its style is practical, no nonsense, high yield, hype free. The class is evergreen, meaning that you can get it anytime you want. And it's always available. So you can buy it now, take it this week. You can buy it now, take it in a month, buy it now, take it in a year. You have access to it forever. You can come back and review whatever you like. There are over 25 hours of content in the course from more than a dozen instructors, and we're adding stuff to it each year. So you get all those future editions included in the one price you pay. No ongoing subscriptions, just one flat price that you pay to have access to the course forever. It includes a pre-test and a post-test, so you can actually gauge how much you're learning from the course. If you just want to check it out, there is no risk to you. We have a 1-week, no questions asked, 100% money back guarantee. As long as you email us within 1 week of purchase and you've watched less than 20% of the class, we will give your money back, every dime of it. If you want to learn more, you can sign up at whitecoatinvestor.com/no-hype. I think you ought to do it today. Thanks for your time and attention in this masterclass. I hope it's been worth the time and effort you put into it.